Let's bring in former Treasury Secretary Larry Summers in an exclusive interview. We got a taste of how you feel looking at your Twitter feed, Larry Summers, but I don't think you agree with what the Fed did or said yesterday. Why is that?
I don't think there was a basis in either financial stability or price stability for raising rates yesterday. We've got inflation under control, on some measures even declining. If anybody thought there was complacency in markets a month ago, they certainly can't think there's complacency after the events of the last several weeks. So I didn't see the need for a rate increase. And I think the greater risks to the economy are turning over and slowdown rather than some kind of acceleration in inflation.
I guess one of the questions, Larry, is just how quickly the Fed ought to turn 180 on its outlook. If they've said we're not yet at neutral, we want to get to neutral, did they not send the gestures yesterday that they thought that they were moderating the outlook for rates?
Maybe they did a little bit, but judging by the market response, they didn't do so with sufficient force and in a sufficiently convincing way. I think we need a greater return to agnosticism on the part of the Fed. You know, sometimes there's predictions that they're going to ease and that they're going to tighten a great deal, as there was in October. Then there are predictions that are much more on the easing side, as there were several weeks ago. I think the Fed just needs to recognize that, just like the rest of us, it doesn't know what the future will hold. Needs to proclaim its data dependence, needs to watch the ongoing flow of economic statistics very carefully, and needs to be careful about sending such strong signals.
So, Secretary Summers, given you disagree with what the Fed did and are worried about the outlook, you disagree, we know from having you on a lot, with a lot of President Trump's economic policies. Would you be an investor in this market? How would you be positioned? Are you in this market?
Oh, I'm not sure. I'm not sure I'm here to give economic advice. Usually, it's a bad idea for people to try to time markets and to move in and out a great deal based on some kind of assessment. The available experience is that almost nobody can time markets accurately. So my general advice to people would be choose an asset allocation between stocks and bonds, choose overall asset allocations that reflect your attitude towards risk, and then stick with it as markets fluctuate. Don't
I guess what I'm getting at
kid yourself that you can catch a falling knife. Don't think that you should panic after markets have just gone down.
What I'm getting at is how much do you think that the economic outlook for the U.S. has changed as a result of some of these tighter financial conditions? And what message are you getting here from the markets as it relates to the outlook?
Look, I think that you already had a lot of risks coming into 2019. You had the lagged effect of tightened monetary policy this year was going to kick in. You had an end to growing fiscal stimulus. And those two things, combined with a great deal of geopolitical uncertainty, combined with domestic policy uncertainty, meant that you were heading into a very uncertain and uneasy environment. And now you have added to that a high degree of volatility and uncertainty in financial markets. And so you add all that up, and the risks certainly look greater than they did a few months ago.
And how does the potential changed incentives of the new tax structure and all that, that is what we just had Kevin Hassett on. They keep talking about that maybe it's going to change the trajectory of the economy, at least at some point if things kick in that way.
Look, you put money into the economy, some of it gets spent. In that sense, this was fiscal stimulus. But that, of course, has a little bit the element of a sugar high, because unless you keep growing the stimulus, you don't keep maintaining the high growth rate. The concern always was that this tax cut wouldn't do anything on the supply side. And if you look, the main thing that's been encouraged so far has been share buybacks. If you look for any evidence of investment exceeding forecasts, you don't see any. If you look even at surveys of business economists who like tax cuts because they're for businesses, and you ask them, has the tax cut spurred investment? The vast majority say it has not spurred investment at their companies. So we basically had a rather unfortunate use of the federal government's fiscal capacity to reward already fortunate corporations that were already enjoying profits at near record levels. So I don't think that was a well-conceived or well-designed economic policy.
Just back to Powell for a moment. I just wanted to get this clear, just in defense of the Fed chairman. You know, central banks, as you know, look at the whole picture of the economy, and the markets don't necessarily always represent the economy, and in fact can often be disconnected and divorced from what's actually happening. And if you look at the economic picture right now, Secretary Summers, it doesn't look all that bad. It may be worse than it was earlier in the year, but how as a Fed chairman should he be thinking about that relationship between the markets and the economy and the different signals that both are sending?
I don't think it's the job of the Fed to put brakes on the economy for the sake of putting brakes on the economy. I think it's the job of the Fed to be highly vigilant with respect to price stability and with respect to financial stability. With respect to price stability, the Fed has a 2% inflation target, and it looks like for the 9th year in a row, we're going to fall below that 2% inflation target. Moreover, the Fed emphasizes that it's a symmetric 2% target, so when inflation should be above 2% as often as it's below 2%. If a moment when we have 3.7% unemployment, a moment when we're in the 10th year of economic expansion, if that's not the moment when we should be above the 2% inflation target in support of symmetry, I don't know when that moment would ever come. And yet inflation is declining. That's why I find it so surprising that the Fed's judging it imperative to raise rates. There might be a circumstance or a situation where it was a good idea to raise rates even in the absence of inflation because you thought financial markets were becoming frothy. But surely by this week, our problem wasn't that there wasn't enough froth or wasn't enough doubt in financial markets. And so neither on financial stability nor on price stability grounds is it easy for me to understand the case for a rate hike this week.
Do you have a thought, Larry, on the balance sheet side of things, either on a kind of philosophical, theoretical, or practical level? Should the Fed be rethinking this idea of shrinking its balance sheet at this pace?
I don't think at this point. I think that if you want to have the balance sheet to expand during recessions, you can't take the position that whenever there's a recession, we're going to expand the balance sheet, and whenever there's a boom, we're not going to do anything to the balance sheet. So I think putting the balance sheet in the background on a roll-off, as they've done, seems to me appropriate. I think Jay Powell's reluctance to get in the business of month by month calibrating and making decisions about that was also a reasonable decision.